I mean, the thick of earnings season, and watch out for Dixon Technologies, because what we've seen is actually, um, you know, numbers below what the street was expecting. But what we need to watch out for from the reaction is how the revenues and the margins guidance has been cut by the company. Is there a slowdown in client addition? What will be the outlook for margins going forward? Why has there been a revenue guidance cut as well? That and more is what I'm going to be discussing with Atul Lall, the Vice Chairman and MD of the company, now joining us here on the channel to talk about the third quarter that's gone by, which, Mr. Lall, was clearly a very tough one when we look at the numbers. But more than that, the way we've seen the revenue guidance being cut to 12,000 crores, earlier it was 15,000 crores. So, what made you do this? 12,000 crores, and can you give us any guidance for the new financial year?
So the revenue targets, we have had a relook at it because of a couple of reasons. One reason is slowdown on the mobile side, particularly on the export front side, which has had an impact. And the second one is the decline in the unit value of LED television, which is a large business for us. As far as the volume is concerned, that's as per the budgeted plans. So these were the two challenges, and that's the reason there has been a revision in the budgetary estimates. The positive has been that there has been a significant margin expansion and also strengthening of the balance sheet by significant reduction in debt, which will further improve our ROCE. For the next year's guidance, we are still in the budgeting exercise. We are doing that internal numbering, and we'll revert to you later. But please be rest assured, we are committed to a significant growth phase.
Okay, fair enough. We'll look forward to a little more clarity on that margin guidance as well down the line. But Mr. Lal, you had also spoken about a slowdown in Q3 for mobiles. Are you seeing a bounce back here, or will your mobile revenue continue to remain under pressure for the next few quarters?
So at present, there is slight recovery on the domestic front side. On the export side, we feel that it's going to take some time for the order book to strengthen. In the meanwhile, we're working on some new customer acquisitions. We are fairly confident those customer acquisitions are going to conclude in a short span of time, which will significantly improve the mobile numbers also.
Okay, so we'll wait for you to give us an update on when you have those new clients. Can we make a conclusion, Mr. Lal, that therefore, because of what you're seeing in Europe and US and the kind of conversation we're having, hard landing, soft landing, is this the start maybe of the export-oriented business taking a further knock? Because we don't know when that is going to come out in the green. You've talked about the revenue guidance cut. We still need to talk about the margin guidance cut as well.
So the margins in our case are going to expand. They're going to expand by 30-40 bits. So we can see a margin expansion because of significant value engineering, cost optimization, operating leverage generated through scale. Combination of all these factors, you will see a marginal increase on the margin profile. As far as the demand recovery on the export side is concerned, we are sanguine about it. We are watching it very closely. We feel that the new customer acquisitions, not only in mobile but also in our other businesses, is going to help us in building up our export base.
Okay, just looking at your overall, segmental performance, and your mobile phone revenues as well have come in lower by about 43%. Just looking at the outlook on the TV segment, etc., lighting, consumer electricals, across the board, there has been a slight slowdown. I just want to understand, for the TV segment, there would have been some realization decline, which led to the revenues overall declining. Can you give us a sense as to what the outlook is on volumes and what is the industry demand like?
So we are the largest manufacturers of LED televisions in India. Please appreciate that the market as such has not grown in the present financial. However, our volumes are going to grow by almost 18 to 20%. So volume growth is very healthy. As far as the value is concerned, an average TV value in the year 21-22 was approximately 17,000 rupees. Due to a significant decline in the major input, that is the open cell, the average value has come down to almost 11,000 rupees. And that's the reason the revenue is under pressure. The volume growth is going to be 18-20% in the current fiscal itself. So that's the scenario on the television front. And also, not only the volume growth is healthy, also the margin profiles have significantly improved.
Okay, Mr. Lal, we're going to leave it at that. So that is the company's reaction when it comes to, making sure the revenues stay around these kind of levels as we see recession in its where it does business in areas like Europe as well as US. Revenue guidance cut from 15,000 crores to 12,000 crores as there's a slowdown for mobile phones in overseas geographies. Mr. Lal, thank you so much for being here with us. The good part news, of course, will be that going forward, we're going to see margin expansion.